If you wanted to tell your audience, the people love you, man. People love you.
No.
If you wanted to tell the audience something right now, any words of encouragement?
You know what? I think that honestly, guys, I think the biggest thing is like as we're going into 2024, it's all about relationships. It's all about relationship. It's all about defining the service that you're providing your client, making sure that your value proposition is true and strong, and you stand behind your value proposition and your offerings to your consumer. And I think that as we navigate, because we're getting back to a realistic market, so I think the value that a full service realtor, a realtor that's well educated, a realtor that's got, as I mentioned, a strong value proposition, the ability to negotiate, right? Because that was kind of somewhat taken out of the equation for a period of time, but somebody that's able to negotiate and substantiate the value of real estate and really understand where the value of real estate comes from is going to be an asset to consumers.
That's good.
Right?
That's good. Do you think there's going to be an impact with what's going on in the States with the buyer agent commissions? Like pretty much buyer agents, I don't know what's going to happen. Like, will buyer agents have to like fend for their commissions? Like, will it still be included from the sellers? Like, what do you think is going to happen?
It's hard to say what's coming down. I mean, TRESA, which is taking into effect on December 1st, accounts for that, and there's going to be an opportunity for listing agents to sit down with their clients and basically define the listing agent service, the menu of services that they're going to provide for that consumer, and then have a conversation with them as to a potential offering for a buyer agent. What does that look like? How can it benefit you? And then the client, the seller, is going to choose essentially what package or what commission compensation they're going to offer or agree to offer out to a buyer representative. It's different in Canada. The way that we do real estate is different here. It historically has been different. I would say it's actually better organized, it's better structured, it's better protected.
Consumers better protected, yeah.
100%.
Yeah. Ansel was telling me the other day that in the States it's a little bit different, that pretty much for you to be on MLS, you had to offer that 2%, that 2.5% to a buyer agent. And here in Canada, the Competition Bureau, I think he mentioned, had already cracked down on that. And that's why you saw, you could offer $1.
Well, there's different models.
Yeah.
There was different models that basically had an opportunity to enter the marketplace and give consumers more choice, depending on the type of service and the level of service that they essentially wanted and the type of representation that they wanted. So there are some definite definers and differences. I mean, it goes all the way back to, honestly, Leo, if you look at even our banking system, right? The way that money was lent out and who received money and who was able to qualify for a mortgage and all of those things. Like when the crash happened back in the early 2000s, like 20 some odd years ago, it didn't impact our Canadian markets, right? Like we just kind of went through, and that was, I think, a lot to do with the Bank of Canada and how they implemented certain things like the stress tests and ways to qualify and so forth. So you legitimately needed an income. You legitimately needed a good credit score. You legitimately needed a long-term employment history. And that wasn't necessarily the facts in the U.S. And hence when things turned, they turned very, very quickly. Like even now, we've gone through almost 2 years of a changed market, a shifted market or a restructured market. And for the most part,
there's not a ton of default.
There's not really a lot of stuff that's happening other than, people are having to watch where they're spending their extra monies. And they're certainly having to, I think some luxury things, like they're being careful as to, any extra luxury things that they're adding to their homes and that type of thing. Maybe the renovation industry is starting to slow down. I have a few friends that are in that industry that, were throwing or giving away contracts before, and now they're essentially open to talking to people and negotiating on their contracts and that type of thing. But for sure, I think the protection that the Bank of Canada put into place 2 or 3 or 4 years ago, where in theory, even if you were getting a 2% interest rate, you had to qualify at 5.
4 or 5, yeah.
Right? So the affordability factor is somewhat still there. Prices have pulled back in some marketplaces. In most marketplaces, prices have pulled back to adjust for that. So I actually think that for people that are either sitting on the fence or looking for opportunity or couldn't get into the market before, if you can get creative with your financing and get in front of the right financiers. I know you guys are actually having a thing tonight with Scotiabank, as a matter of fact, to help out with people trying to get into the market, and probably some people that are trying to get back into the market will attend your event. But those conversations and getting the right people in your corner, your realtor, your insurance person, your mortgage person, the right lawyer to tell you about the programs that are out there, the various mortgage packages that are out there, right? Because now there's longer amortization periods, which can help reduce your payments until interest rates pull back.
Yeah.
Right. And the speculation, actually, we had a meeting this morning and we were just told that the long-term fixed rates, so the 3 and the 5 year fixed rates, actually pulled back. I think it was by 25 basis points. So for the first time in a couple of years, we've actually seen the fixed rates come down. So that's fairly promising. We've had 2 announcements where the rates didn't go up, and now we're seeing them come back down. So I think, the banks and the economists and those that essentially impact and control some of the factors that impact our economies understand that the housing market and the pent-up demand. I don't know about you guys, but the feedback that I'm getting from agents, like, did anybody do an open house this weekend on the team?
We did. Yeah, we did 2, actually. Tony did one. Shadi did another. And they both had the exact same. It had 7 groups of people go through. So yeah, I think a lot of people have kind of been on the sidelines and kind of just like waiting for things to bottom out. And I think everyone's kind of realizing this is it. Q4 2023 is when things are bottoming out. And 2024, I think a lot of people have high hopes. We actually, and this is a pretty neat infographic that we got from the Greater Ottawa Home Builder Association, where the new build home sales were actually about 169% higher. That might be the wrong figure, but let me pull it out. But it was about 169% higher in October of this year than October of last year.
Yeah, I believe that.
So last year, right? Because last year the new home prices haven't adjusted perhaps as much. People were super skeptical of buying a house, buying a townhouse for $750,000, $800,000 and getting it in 2 years where you don't know where the market's going to be. So home sales have that's new construction, right? So people are starting to get back into that mode, right? Also, someone else told me that Minto released some I don't know if it's condo townhouses or stack townhouses in Canada, and there was people lining up,
camped out.
People camped out, lining up since 5 a.m. I mean, this is we haven't seen that in a while. The new home builders were a lot of them actually paused. A lot of them weren't even building. So I think it's something to really. It's an indicator, right? The buyer confidence seems to slowly coming back.
So here's the reality of it. When you look at real estate, if you're looking at it over a 12-month period, I mean, your risk factor is significant. Yeah. When you look at real estate and you say to yourself, okay, I want to buy a home, or I want to buy a property for, to invest in, or whatever the case may be for the next 10 or 15 or 12 or whatever amount of years, you got to look at the cycle over time. And really, any graph that you look at, I don't care if you can go on right now, pick any company you want, everything goes through cycles. There's no graph that goes completely straight up. It just doesn't happen, right? Everything tends to have a turn at some point. There's other external factors that may impact why things take a turn, and impact why, there's the spikes in graphs and so forth in production, or whether in volume, or whatever you want to account for. And I think the reality is that where we're going right now, and if you look at economically, I know everyone's like, it's doom and gloom and all this. The world's not stopping. Go to any grocery store, shopping store. I know it's not the same, but even places like the Costco's or the Walmarts or whatever, where people are spending considerable amounts of money on their outings, right? I mean, their carts are full. Try to buy a car today, right? You're still waiting a year and a half for a very expensive asset that actually depreciates in many cases. So I think it's just a matter, especially in our city, right? We're historically a conservative city. And when things change, usually things do come to a very, very quick halt. At the same time, I think our consumers that live here, and like you said, look, you guys had 7 to 8 groups, and that's what I heard from most of our realtors about the open houses this weekend. People don't window shop real estate, right? People window shop other things that are, essentially more tangible, but they don't usually window shop. You're not wasting your Sunday saying, I'm going to look at open houses. So these are, I believe, legitimate consumers that are just waiting for the right time to make that move. And there is no doubt a pent-up demand. In the metropolitan or the urban areas of the city, there's still really, really little inventory.
Yeah.
The suburbs a little bit more. I think the builders have gotten a little bit more aggressive on their pricing, and they've adjusted some of that pricing to account for what's happened in the marketplace. There's buy downs.
There's great opportunities. Like this is a good tidbit here, Chris. There is great opportunities right now with pre-construction homes. Some buyers, over the last 2 years, again, would have bought a brand new townhouse for close to $800,000. That same townhouse is being sold right now by the builder for say $650,000. Like that's a great opportunity for that buyer, for a new buyer, right? Someone was already willing to pay. Someone already paid, $150,000 more for the same product a couple of years ago. So I think.
So here's the beauty of it, and this is the other way to look at it as well. So I think it's important to do a calculation between that $800,000 home a year and a half ago and the interest rates at whatever they were, 2.5%, or 3%, and then look at it today. And if the rates are at 6%, for example, but the property is now 670 instead of 800, but you also got to look at, okay, would I rather be paying down a $670,000 home or an $800,000 home? Because I think what you need to look at is, and they can do calculations at the financial institutions that even if the rates stay at 6%, which we speculate they won't, but even if they do over the next 10 years, look at your pay down and what the balance is on the difference on your mortgage in comparison to if the home was at $800,000. So there's like different ways of looking at it, and the realities are this. Most of our cycles that happen in real estate, when we do see a downturn market, it usually lasts for anywhere from a year and a half to 3 years. We're at the 2-year marker, so you have a choice, and that is you can either wait to time it, but I'm going to tell you, if for whatever reason things do start, that momentum starts, it's probably going to pick up speed pretty quickly.
It's going to be too late.
Possibly.
Yeah.
Possibly. Like, we can never be sure, but I mean, I've been doing this for 35 years. I've seen different cycles in the market, and I've seen how quickly it can return.
Yeah.
And those 7 people that were out looking at homes, actually, I was talking to an agent last night that called me and said, I'm in a multiple offer situation. I'm like, what? Yeah. We haven't seen a lot of that. So people are now saying, okay, maybe it is the right time, or we've hit that sweet spot where rates dropped a little bit, prices are right at the right point. I can actually have a choice of the type of house that I want to buy because there's just a little bit more inventory on the market. And really, historically, if you go back pre-2019, 2020, when there was a little bit of craziness in the market, the months of October, November, December, January, even in reasonably stable markets, are typically times in the market where there's more opportunity.
It's slow.
Because if you wait until February, March, April, that's where your majority of your momentum picks up. Yeah. And typically you still have a shortage of inventory at that time. So
that's it. Yeah. That's it. That's bang on. So the best time to buy a house is always 5 years ago.
It's like I said, if you're thinking if you're thinking you want to buy something now and make money in 12 months, nobody knows. If you ask me right now, if I bought a house today at the end of 2023 and by the end of 2027 or 2028, is there a good chance that my property is going to increase and I'm going to have some appreciation? I'm going to say to you, there's a high probability. Now, to time it, whether it goes up 14%, 18%, or 7% in that gap in that time frame, nobody knows. Ottawa real estate has performed at just under 5% on average increase over the last 50 years, if we look at the graphs. So, I think there's so many variables when especially if you're buying a home for your own principal reasons, meaning you're going to live in it and, start a family or raise a family or, that type of thing. I just think, it's still a far better off investment, and certainly nothing against anybody that's renting or whatnot. But I think in the long term,
if you're able to get in,
don't get out. And if you're going through this current flow in the market and stuff like that, and maybe you're having a bit of a tough time and you need some guidance, like reach out to Leo or Jen or any team member at the GoodStory team and have a chat with them, because they have lenders and there's ways to kind of get over the next 2 or 3 years or whatever that time frame is until things pull back. Get creative. You can extend your amortization. And the great thing is you can go back in 2 years and renew that and shrink down the amortization if rates, in fact, do pull back. So lots of options.
Yeah. Thank you so much, Dan. Thank you for coming.
No problem.
Much appreciated.
Gotta go.
Dan Salhani, leader here at Remax Hallmark.
Thank you. And influencer. Follow me on my Instagram page.
Hashtag influencer.
Dan Salhani Realtor.
Hashtag Dan the man.
Thanks, guys.